Hey everyone, welcome back to the channel. Today, we're tackling a concept that's grabbing headlines for some time and sparking serious debates: retiring early, specifically around age 40. It sounds like the ultimate dream, leaving the 9 to 5 grind to live life on your own terms. But is it true freedom or just a financial fantasy? Watch till the end for my personal perspective. Now, let's understand, what is the FIRE movement? It's an acronym, FIRE, and it stands for Financial Independence, Retire Early. The core idea is simple: aggressively save and invest a significant portion of your income, sometimes 40% to 50%, so your investment portfolio grows large enough to generate income that covers your living expenses for the rest of your life. The amount people aim for is typically 25 times their annual expenses. Once you reach that level, you can theoretically withdraw around 4% of your portfolio each year without reducing your original corpus over time. This works on the assumption that the rest of your investments continue to earn around 10 to 12% on average, helping your wealth grow even as you draw from it. Here is where the rubber meets the road, especially in the Indian context. If you retire at 40, and with the average life expectancy in urban India trending towards 70 to 75 years, and climbing, you could easily have 35 or more years of life to live. Let's look at some of the challenges. The longevity and purpose puzzle. First up, longevity and boredom. The romantic idea of endless holidays soon fades. You can only travel so much, and remember, holidays are expensive, which depletes your finite corpus faster. As the saying goes, an idle mind is a devil's workshop. You need a plan for your time, otherwise you get the retirement blues. Next is the fear of, will it be enough? Even with careful planning and perfect spreadsheets, life doesn't always follow straight lines. A bad market year, unexpected expenses, or medical emergencies can shake your confidence. You might start questioning whether your savings will truly last, and that constant uncertainty can bring stress and anxiety, even if the numbers say you're fine. Then, there's the frugal trap. Living frugally helps you reach financial independence faster, but it can also rewire your mindset. After years of cutting corners and saying no to small pleasures, it's hard to start spending guilt-free even when you can afford to. You may find it difficult to shift from saving to live to actually living fully. Next is the social disconnect. You may be free, but your friends and peers will likely still be deep in their careers, not available for weekday golf or impromptu trips. This can lead to social isolation and a feeling of being out of sync. You will have to develop new friendships. Finally, the crucial need for purpose. Above all, everyone needs purpose. Retiring from a job doesn't mean retiring from life. This is the most crucial aspect to plan for. Your post-FIRE life needs meaningful activity. This could be something altruistic like volunteering with an NGO, pursuing a creative passion you deferred, living off the land, or simple living. Becoming an angel investor or mentor, it's not a full-time job, but a purpose-driven pursuit. Now, let's look at the Indian reality, the family factor. For us in India, FIRE planning can't just be about your life. It's about your parents and extended family. Many of our parents didn't purchase comprehensive health insurance during their working years. As they age, their healthcare needs will become significant and incredibly expensive. You will need to support them financially. One huge benefit of working in a good corporate job in India is the group medical coverage, GMC. Many organizations offer the option to include your aging parents in the corporate health plan, often at a low or subsidized cost. This coverage is often superior to what you can buy individually for a senior citizen, sometimes offering zero waiting periods for pre-existing diseases. By retiring, you immediately lose this essential safety net for your parents, forcing you to pay for expensive individual senior citizen plans out of pocket, which can be a huge unbudgeted expense that can derail your FIRE plan. So, how do we plan for FIRE? Let's assume you're a young professional, 23 or 24 years old, and you're ambitious enough to start your FIRE journey early. It all comes down to time and compounding. Starting in your early 20s gives you a huge head start, nearly 16 to 17 years of prime earning, saving, and investing potential. First, understand your financial independence goal. Instead of chasing a fixed number, start by getting a sense of what financial independence would look and feel like for you. Think about the kind of lifestyle you want, where you live, how you'll spend your time, and what your monthly expenses might be. Once you have that picture, you can estimate what it might take to sustain it, a ballpark idea of your freedom fund. As a broad guideline, many people use about 25 times their annual expenses as a reference point. But remember, it's not about hitting one magic number. It's about reaching the stage where your investments comfortably support your choices and you no longer depend completely on a paycheck. When your investment income begins to cover your living expenses, that's your real milestone, your first taste of financial independence. Save aggressively and grow your income. To reach FIRE by 40, the usual 10% to 15% savings rate won't be enough. You'll need to be disciplined. Aim to save around 50% to 60% of your income. And saving alone isn't enough, you'll also want to increase your earning potential. Focus on skill building, promotions, or even starting a side hustle. The higher your income, the easier it becomes to maintain that high savings rate without feeling restricted. Make your money work for you. Your money needs to grow faster than inflation. In India, inflation averages around 5–6%. So your investments should ideally grow at 10% to 12% or more over the long term. That means putting your money to work in growth assets, equities, index funds, and mutual funds, instead of just keeping it in low-return options like fixed deposits. The goal isn't just to save, it's to build wealth that outpaces rising costs and keeps your financial freedom sustainable. If you are enjoying this video, don't forget to like, share, and subscribe. We simplify the path to financial freedom. Coming back to our question, is FIRE a freedom or a fantasy? It's a powerful possibility, but only if you plan for it. Here are your key takeaways. 1. Financial corpus. Your savings must account for 35 plus more years of existence and combat high inflation, 5 to 6%. Ensure your investment returns beat inflation. 2. The family buffer. Dedicate a significant, separate portion of your corpus specifically for aging parents' healthcare. Don't underestimate this cost. 3. The purpose plan. Don't just plan your exit, plan your life after. Define a purpose that will sustain you for 3 to 4 decades. FIRE is achievable, but it requires a holistic approach that goes beyond just saving money. It demands planning for longevity, purpose, and familial responsibilities. What are your thoughts? Are you pursuing FIRE? Let me know your biggest challenge in the comments below. My personal take. I'd rather aim for financial independence than early retirement. Because for me, financial freedom isn't about quitting work. It's about choosing the kind of work I want to do and deciding how much of it I want in my life. Retiring too early can create a sudden void, that feeling of, what now? I'd much rather design a life that includes purpose, flexibility, and joy, where work adds meaning, not pressure. So instead of planning just for retirement, I'd plan for the life I want to live, the lifestyle I'd enjoy, the experiences I'd cherish, and yes, the vacations I'd love to take. For me, it's all about finding that balance between financial security and a life that feels truly fulfilling. And what about you? Would you rather retire early or create a life so meaningful that you never feel the need to? Tell me in the comments. I'd love to hear your version of financial freedom.